The news is tightening around MNCs. The G7 nations are close to signing an agreement that will require giant MNCs to pay a minimum reasonable tax in countries where they earn their greatest slice of profits. Good morning, good afternoon, and good evening, ladies and gentlemen. I'm Anish, and in this video, we will discuss the G7 nations' deliberations on tax reforms that's gonna have global implications. The agreement rests squarely on two main pillars. The first pillar seeks to usher in changes in international tax system in an increasingly digital world by reallocating taxation rights on business profits in such a manner that the question of physical presence would be rendered immaterial. Instead, governments would be empowered to tax MNCs based on the share of profits earned from the consumers falling within their respective jurisdictions. The second pillar is designed to fix the minimum global corporate tax rate to 15%, a move that will stop countries to deliberately lower their tax rates in order to incentivize MNCs to set up their headquarters there. The details of how the minimum rate will operate are crucial as different countries have their own rules of computation of a company's taxable profits. Clarity and consistency are going to be the difficult bit so that the profits are measured in the same way everywhere. If this deal goes ahead, there will be losers and winners. Tax havens that have so long relied on companies that only nominally locate there will tend to lose out. Bermuda and Channel Islands will cease to attract companies once their low tax rates are no longer available. The deal is also not great for developing countries, which are unlikely to get much tax out of a revenue sharing deal based around where sales are made. And what about India? The tardy progress over the base erosion and profit shifting, that is the BEPS framework, prompted many countries like India to impose their own versions of a digital tax. India imposed an equalization levy in 2016 that mandates every Indian entity to withhold 6% of payments made for specified services received from entities located outside India. India will no longer be able to continue with these digital taxes once the global tax agreement is in place. Hence, experts suggest that India may end up with lower revenues in the new regime. Moreover, researchers have found that the developing world are quite skeptical about the flip side of the story, as global leadership requires going beyond national interests to ensure that all countries have sufficient resources to build healthier post-pandemic economies, more so in a way that is not only historic but also fair. The first concern regarding the G7 agreement is that the proposed minimum tax rate of 15% is low and close to the prevailing rates in tax havens such as Switzerland and Ireland. With a 15% tax rate, the EU Tax Observatory estimates South Africa and Brazil to gain an additional 600 to 900 million euros only, as compared to 2 to 3.5 billion euros at 21% rate. The second part of the G7 agreement that envisages apportionment of MNC's global profits for tax purposes would apply only to largest firms with a global profit margin of at least 10% and only 20% of the so-called residual profit exceeding this threshold would be subjected to apportionment among countries. This is much lower than what G24 and African Tax Administration Forum, that is the ADAF, had demanded. That is a reallocation percentage of 30 to 50% of all global profits, whether residual or routine. Such a rule would help to establish a more level playing field. Instead, the G7's proposed distinction between residual and routine profits seem to reflect a political agreement aimed at avoiding a more far-reaching reallocation of taxes and revenues. Hence, ironically, the global tax negotiations seem to mirror the ongoing COVID-19 vaccine discussions at WTO, where EU leaders are blocking temporary exception to IPRs as demanded by developing countries. So, ladies and gentlemen, this brings us to the end of this video, and please do hit a like, share and subscribe, and please don't forget to drop a comment. Thanks, take care, bye.